Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing reports that companies put out. And I promise when we leave here today, you will understand Nuburu's latest S-1 filing. Alright, so Nuburu Inc. has filed a prospectus, a document that essentially tells investors what they need to know before buying in. And wow, there's a lot to unpack here. Think of this prospectus as the company's tell-all story for investors. And it's definitely got some dramatic twists and turns. Nuburu Inc. is a company that's gone through a lot of changes, especially since its IPO. They merged with a company called Legacy Nuburu back in early 2023 and have since been trying to navigate the tricky waters of being a publicly traded company. They're calling themselves an emerging growth company, which means they get to follow some slightly relaxed rules for public companies. It's like a bit of a cheat sheet for reporting requirements. They're also a smaller reporting company, which gives them even more leeway. But don't let that fool you, this company has been through a tough time financially. The main point of this filing is about selling up to about 26 million shares of their common stock. Who's selling these shares though? It's not Nuburu itself getting the cash, it's the selling stockholders who are cashing out. This means existing investors, mostly those who lent money to the company through convertible notes, are now getting to convert those notes into shares and sell them. And who are these selling stockholders? Well, the biggest one is Indigo Capital LP, a group that's lent the company a massive amount of money through several convertibles notes, totaling well over $3 million. They're cashing out a big chunk of their investment by converting their debt into nearly 20 million shares of stock that they can now sell. Then there's Brick Lane Capital Management Limited, who also lent money and are now converting their debt into almost 70,000 shares. And Bomber Opportunity Group Limited, who are converting a note into over 1.5 million shares. Torcross Capital LLC also gets to convert a note into nearly 8,000 shares. Diagonal Lending LLC is also involved with a couple of convertible notes, converting into over 2.4 million shares. And Boot Capital LLC converting a note into about 46,000 shares. So basically a lot of debt is being turned into stock, and those investors are now looking to sell that stock on the open market. Crucially, Nuburu itself isn't getting any money from these sales. All this cash goes to the former lenders. Nuburu is just facilitating the sale through this registration process. Now let's talk about the risks, because Nuburu is upfront about them, and there are a lot. They're an early stage company with a history of losses, which is a very polite way of saying they haven't been profitable and might not ever be. This is a big one. They constantly need more money to keep the lights on and grow. If they can't get that money on good terms, it could really hurt them. They've already gotten a notice of non-compliance from the NYSE because their stock price has been too low and the company has been losing money. Let's dive into the financials, because this is where the story really gets interesting. For the year ending December 31, 2024, Nuburu reported revenue of just over $15. Now compare that to 2023 when they brought in over $2 million. That's a massive drop of nearly $2 million, a 92% decrease. That's a huge warning sign, and the losses, yes, they're still significant, with a net loss of over $34 million in 2024. That's up from a loss of about $20 million in 2023. So not only are they not making money, they're losing even more money than before. Their cost of revenue went down too, from over $5 million in 2023 to just over $2 million in 2024. This seems like good cost control, but when you pair it with the massive revenue drop, it just highlights how little business they're doing. One of the most eye-popping numbers is a whopping $20 million loss on debt extinguishment in 2024. This happened because they essentially swapped debt for stock. While it cleared some debt, it also added a massive hit to their bottom line. This phrase is almost a mantra for companies in this situation, and Nuburu repeats it often. They are very clear they are not profitable, and there's no guarantee they ever will be. They've got a lot of irons in the fire with new acquisitions and strategies, trying to turn things around. Looking at their balance sheet as of December 31, 2024, we see their cash position has dwindled significantly to just over $2,000. Their total assets have also dropped from over $10 million in 2023. On the other side of the balance sheet, their accounts payable have ballooned to over $6 million. This shows they owe a lot of money to their suppliers. When you combine this with their low cash on hand, it paints a picture of a company struggling with immediate liquidity. Speaking of short-term obligations, their total current liabilities, which are debts due within a year, are over $20 million compared to just under $10 million in the prior year. That's a massive increase in obligations they need to deal with soon. Their total liabilities are also much higher than their total assets, creating a significant deficit. Even in the more recent interim numbers for the 3 months ending June 30, 2025, they reported a net loss of over $12 million. For the 6-month period, they are looking at a net loss of nearly $29 million. These numbers are substantial and show they are still burning through cash rapidly. This constant struggle for cash is the central theme of Nuburu's story right now. They're heavily reliant on financing from investors, and these new convertible notes and equity agreements are a way to keep the doors open, but at a cost, often through significant dilution for existing shareholders. And even their auditors are sounding the alarm. Their report mentions substantial doubt about the company's ability to continue as a going concern. This is a serious warning that the company might not be able to survive without significant financial help. They also had to recast their financial statements from previous years due to misstatements. This raises questions about their internal controls and accounting accuracy. So what does this all mean for investors? Nuburu is in a very precarious position. They're trying to pivot their business model, invest in new areas, and manage a huge amount of debt that's being converted into stock. The risk factors are extensive, covering everything from their ability to get future funding to potential litigation and the volatile stock market. Ultimately, Nuburu is a company trying to reinvent itself amidst significant financial challenges. While they have innovative technology, the path to profitability is incredibly uncertain and heavily dependent on further funding and successful strategic shifts. Investors should be very cautious and understand the high degree of risk involved with this type of investment. That's our deep dive into Nuburu's latest filing. What are your thoughts on their turnaround strategy and the risks they face? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate decode sessions. For more real-time insights and to connect with fellow finance enthusiasts, join our Discord community linked in the description. Thanks for watching, and we'll see you in the next video.